In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, hundreds of millions of Facebook passwords visible to its employees. The social network admits to an egregious flaw that dates all the way back to January. Plus, Amazon has been beta testing video ads on Apple's iOS for months. Its latest attempt to grab a bigger chunk of the $129 billion digital ad market dominated by Google and Facebook. And Lyft's IPO roadshow kicked off this week as the ride-hailer gears up for what could be the biggest U.S. public debut so far this year. We will discuss the prospects with some early investors. But first, to our top story. Another day, another Facebook controversy. The social network admits the passwords of hundreds of millions of Facebook users were visible to employees at the company from as early as January. The login credentials stored in a non-encrypted, readable format that any Facebook employee could read. Facebook disclosed the flaw after the security blog Krebs on Security reported on it based on a so-called internal source. Thursday, Facebook said the problem has been resolved. And, quote, to be clear, these passwords were never visible to anyone outside of Facebook, and we found no evidence to date that anyone internally abused or improperly accessed them. Sarah Fryer covers Facebook for us and joins us now. What?
It's just another hit at the trust people have for Facebook. I mean, this is following the major breaches we talked about last year when people's logins were taken for getting personal information from their accounts. And then, of course, Cambridge Analytica, which we talked about a year ago to this day, the political consulting firm that got data on millions of Facebook users without their permission. It just keeps coming.
Now, Facebook isn't giving specific numbers. They did say hundreds of millions of Facebook users were impacted. Millions of Facebook users, most of those hundreds of millions of users were using the Facebook Lite app, which is for emerging markets. Millions of Facebook user accounts also impacted, and thousands of Instagram users also impacted. Brian Krebs is saying this could be up to 600 million accounts we're talking about.
Which is a very I mean, that's bigger than most apps we use. I mean, that's a lot of passwords. And so Facebook is going to be letting users know if their password wasn't involved in this problem.
They found out about this in January. They didn't admit to it until now. So for at least 4 months, Facebook has known about it. Shouldn't they have told users about this 4 months ago?
Absolutely. I mean, this is something that they're clearly coming out and saying after Krebs on Security reported about it first. Krebs is writing about it from the perspective of a source. It's unclear to me, like, if that source hadn't told them about it, would we ever find out about this breach? It goes back to what I've been saying, which is Facebook doesn't think of security in terms of security from itself, right? They think about security in terms of third parties, breaches, attempts to share personal information by developers. But when it comes to the information that Facebook is gathering and storing, to them, you know, it's all in the family. It's a very transparent company, and they can keep tabs on that stuff.
It's never happened, as far as we know, at this scale, though there have been smaller incidents at Twitter, GitHub, of this happening. But talk about the irony here, given that Mark Zuckerberg is trying to pivot to privacy, to more encrypted messaging, when they can't even encrypt our passwords.
Well, he joked a little bit about that when he was making that strategic transition. He was like, maybe people won't believe us when we say that we care about your privacy. I mean, this is another example of why people are concerned. It's not that they don't trust Facebook when they say things, it's more about their actions. I mean, this stuff keeps coming up. Doesn't matter how much they say they care, it matters what they do.
Well, Facebook says the issue has been resolved now, 4 months later. All right, Sarah, stick around. I want to ask you about our next story as well. Facebook, as we mentioned, dominates the $129 billion digital ad market in the United States, along with Google. And together, they are expected to make up nearly 60% of total digital ad spend this year. But Amazon has become a serious challenger and is now selling video spots on its shopping app. I also want to bring in Bloomberg Tech Spencer Soper in Seattle. So, Spencer, what do we know about what Amazon has been testing here?
We just know that they've been testing brief video ad spots on their shopping app on iOS devices. That's been in beta for a couple months now, and all indications are that they like what they see because they're trying to sell more of these spots to advertisers and plans to expand it to Android devices as well. So Amazon customers using the Amazon app on Android devices could expect to see these advertisements as well. And so it's basically just Amazon reaching further into that digital ad market and providing another vehicle for advertising, whereas most of their advertising revenue now is from display ads, maybe a brand logo that links to their store, or photos of their products and descriptions of their products. This adds another dimension to that with mobile video.
Now, by one estimate, Sarah, Amazon's digital ad share will grow to 8.8% this year. Google's will slip to 37.2%. How big a threat is Amazon to Facebook when it comes to advertising?
To Facebook and to Google, they are the threat. I mean, there's really nobody else that is challenging the dominance of those two players in mobile advertising. And the other aspect of that is advertisers want another option. They've seen these problems with, for example, the New Zealand shooting last week that went viral on Facebook and on YouTube. They want an alternative to these social networks and places where that kind of content can surface, and Amazon's giving it to them.
You wonder, Spencer, I mean, ads like this seem to be an obvious option for Amazon. Why has it taken them longer to sort of ramp up their ad products?
Amazon's been wary of advertising for years, and it's been kind of slowly ramping up, but we're definitely seeing that they want to juice it more. The fear has always been about compromising the customer experience. Are we going to devalue our web store by cluttering it with advertising in a manner that disappoints our customers? And so what they've been doing is slowly adding it, and actually learning that a lot of customers, supposedly find these advertisements helpful, and so that's why they're just adding more and more. On the video side, what it does is it addresses a shortcoming on Amazon where, simply seeing a photograph of a product or a description of it or even a written customer review of it is not the same as seeing like a video of a product being used or maybe assembled. And what's actually happening is Amazon loses some of that traffic to YouTube, where maybe an influencer is doing a demonstration and a testimonial about a product. Amazon realizes that its lack of video is a weakness, and it needs to fill that gap.
Well, mobile video ads are one thing. What are some other levers that Amazon could pull?
On the advertising side, well, certainly in its Prime Video service, you could see more advertising there. You could see more tie-ups with influencers and affiliate marketing programs. Just like if you go to YouTube to watch an influencer use a product, they could have an affiliate link that goes directly to Amazon or to some other site, so Amazon can try to lock in more people that way. So I think there's definitely more and more headroom for Amazon in the advertising space.
Sarah, we talked about Instagram commerce yesterday, but does Facebook really have a strategy to take this on, even as it pivots to a more private company that could also impact ad product? And with Amazon as well, that seems like it could add up to a kind of a big deal.
I think Facebook is really going through a tough strategic decision-making time right now, where they're thinking, like, how much do we have to pivot into encryption? How much do we pivot into stories? On Instagram, it is very much the brand advertising, the aspirational view of what you could be if you own this product, which is very different than the more intent-based advertising that you see on Amazon. But certainly they are concerned about the rise of Amazon, and that's one reason they've built other kinds of products, like in Building 8, their portal device that is supposed to compete with the Amazon Echo. So these companies are getting more and more head-to-head over the years.
All right, Bloomberg's Sarah Frier and Spencer Soper, thank you both. A race we'll all continue to watch. Thank you. All right, Tesla has filed 2 lawsuits against former employees who left to join startups in Silicon Valley and China, accusing them of stealing confidential information. The company claimed Guang Zhao, a former engineer on its autopilot team, uploaded more than 300,000 files and directories, as well as copies of source code to his personal cloud storage account before quitting the company in January and then joining Xiaopeng Motors. In a separate suit filed Wednesday, Tesla claimed former employees who worked in warehouse and distribution management took information and trade secrets with them to Zoox, another company, to help it leapfrog past years of work, quote unquote. Coming up, Lyft is on the road, hitting New York today before heading to San Francisco next week ahead of its IPO. What its executives are telling investors next. And if you like Bloomberg News, you can check us out on the radio, listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Lyft is pitching itself as a fierce challenger to Uber, and investors are taking a close look at America's second largest ride-hailing company ahead of its $2.1 billion public debut next week. But can the startup win them over? We took a closer look.
2019, the year that so many highly anticipated tech companies plan to go public. Among them, two stand out. A race best described as focus versus frenzy. Frenzy being Uber. Engaging in rapid global expansion and retreat, food delivery, bike sharing, self-driving cars, and flying taxis. Plus a valuation that bankers say could soar to $120 billion. Lyft, on the other hand, may best be described as focus. Launched in 2009, Lyft grew out of co-founders Logan Green and John Zimmer's 2007 startup, Zimride, which connected college students looking for rides, and is focused almost solely on growth in the United States, going from less than a dozen cities in 2009 to 95% of the country in 2019. Lyft now claims it controls 39% of the U.S. ride-hailing market. And it's just starting to go international, launching in Toronto and Ottawa City in 2018. It's keeping up with its top rival by getting in on scooters and bike sharing, buying Motivate that runs City Bike in New York. And yes, it's also working on self-driving cars, buying London-based Blue Vision Labs, beefing up staff working on autonomous technology to over 300 people. Lyft's already courted a slew of major investors like Japan's Rakuten and Andreessen Horowitz. But as it prepares to go public, it's trying to lure more, hoping to impress by doubling its ride count from 500 million in 2017 to 1 billion in less than 1 year. Revenue jumped up 541% to $2.2 billion last year from just $343 million in 2016, with an estimated valuation of $20 to $25 billion. Despite losses increasing 32% to $991 million in 2018. And while Lyft was second out of the gate to launch, it's first in line to go public, weeks or months ahead of Uber. In an increasingly volatile tech market, the hope is investors will hail Lyft's ride.
Now, Lyft's IPO roadshow rolled into New York City today. Executives saying demand already far exceeds the supply of available shares. Joining us to discuss Bloomberg Tech's Eric Newcomer, who was at the event. And Eric, you also saw the investor roadshow video, which is getting a lot of praise. It sounds like it's more of a short film. What do they say in this video?
Yeah, it's super hip. A lot of walk and talks or Aaron Sorkin-esque interviews with executives. You know, it's very heavy on sort of culture, personality. We're going to upend the transportation industry. Eventually, they get to the numbers, you know, very top-line focused with a little bit of a look at what they talk about as contribution margin. But just sort of upbeat, lots of music, you know, we're sort of quirky, fun Lyft.
Speaking of that, as I was watching that last story, remembered my first interview with Logan Green, a co-founder who came in with a giant stuffed pink mustache, which was on the original Lyft cars. But look, let's get serious. I mean, there are a lot of questions here about the numbers. We just spoke to an analyst, Brett Wallace, who says that Lyft hasn't given nearly enough financial information to build a decent financial model whatsoever. Take a listen to what he had to say.
I think it gives Uber an opportunity when they file to competitively sort of take it to Lyft and be more transparent than these guys have been. But so I think what you get right now is what you get, and you can sort of decide if you want to focus on the top line and not worry about the profitability the way that they've asked you to do.
Eric, are you hearing similar complaints to investors or other analysts?
Definitely my sense coming out of the St. Regis was that prospective investors were very interested in a path to profitability. You know, Lyft assured investors that 2019 would be a peak spending year and that money from the IPO would be enough to really sustain them. But definitely that idea that, you know, it's going to be hard to figure out how to model out when Lyft will be profitable, therefore justifying whatever valuation it reaches, is a persistent question. And that'll be true with both companies. I think there is a level of, you know, investors will always complain. We wanted daily active users, you give us monthly active users. So there are going to be quibbles about whether there's enough data to provide the models, but I wouldn't be surprised if Uber does try to take an advantage there and give investors what they want in terms of sort of building out their models for these particular businesses.
Now, Lyft does make some jabs at Uber in the presentation, saying, you know, we're focused solely on consumer transportation, not food delivery, not trucking. That said, how are they explaining to investors, how are they going to get their costs down?
Yeah, I mean, getting their costs down would be partially reducing marketing spending. You know, I think there's always an argument that sort of bigger scale allows you to operate more efficiently. This has been sort of a land grab period for Lyft, you know, while Uber's been on the defensive, making sure that they spend to gain territory, and that once you have the territory, the hope would be that you don't have to maintain that level of marketing because you already have those customers, and then you just re-engage them. That's the theory. We'll have to see if that would bear out.
All right, our own Eric Newcomer on the road for us following Lyft. Thank you so much, Eric.
Thank you.
Coming up, Tencent has reported results that missed estimates amid rising investments in cloud computing and slowing games approvals. We're going to break down the results next. And we're live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network TikTok on Twitter. This is Bloomberg. Tencent reported first quarter results Thursday, posting its biggest revenue decline in a decade. Net income fell 32% as the Chinese internet giant increased spending on cloud computing. This as game approvals slowly resume after a months-long regulatory freeze in China. The company's chief strategy officer, James Mitchell, expects game releases to be slower this year as a result.
Monetization approval for new games resumed in December. So far, 7 new smartphone games for which we have publishing rights have received such approvals. These include titles in the role-playing, strategy, casual, and functional genres. Given the backlog, game releases both for ourselves and the industry as a whole are likely to initially be slower than in previous years.
Joining us to discuss Tencent's results, Bloomberg's Selena Wang. So why the big surprise?
Investors really weren't prepared for this giant increase in spending. Operating costs went up significantly as it's trying to diversify away from gaming. As you know, last year was a dark year for Tencent. They were really hurt by this freeze in regulatory approval for games, and now they're investing heavily in areas like video, cloud computing, fintech, entertainment, because they don't want to be bound to the winds of censors and regulations, and they're expanding into these new areas. However, this is great in the long term for investors, but in the short term, it's having a lot of margin pressure.
So is the worst over? I mean, are they through this game approval issue?
The coast certainly isn't clear for them. And now they are finally starting to get an early start of some of their approvals, but 2 of their biggest games still haven't received the green light to begin monetizing. Now that would be Fortnite and PUBG, which is actually the world's most popular smartphone game right now. And gaming is one thing, but also they have to deal with censors and regulation with all the other content and entertainment areas they're in. During the earnings call, management talked about Chinese costume dramas now being scrutinized by regulators, so they're expecting potentially some decline in online advertising revenue because they can't monetize as many of those shows right now.
And what about management? There's been a shakeup at Tencent.
There's been some interesting changes at Tencent. We most recently reported that they're asking 10% of their management to either step down or leave the company so that they can make room for younger, fresh blood, new management to come through the ranks, and they're really trying to cut out a lot of the inefficiency. This comes after a September giant overhaul and restructuring of the company to really shift towards what the management has called a shift from the consumer internet to the industrial internet, which is really just a fancy way of talking about the emergence of 5G, a bunch of connected devices, and they want to be able to capitalize on that and do a better job of servicing businesses. So that's why they're expanding so much in cloud computing, in enterprise software services. They have something called WeChat Work. But this is going to be a really painful transition because they're far behind Alibaba in this space, especially when it comes to cloud computing, and it's going to take a lot of investment.
That was my next question, is compare how Tencent is performing to Alibaba and Baidu and the other Chinese tech giants.
It's interesting because they have this giant asset that's very important. WeChat has more than 1 billion users. They can use that and leverage it in all sorts of ways, and their advertising ad load is still pretty low when you compare it to a company like Facebook. When it comes to the enterprise space, Alibaba has spent much more time developing their advanced capabilities in areas like cloud computing and other business-to-business services. But it's not just Alibaba that they have to deal with. There's also companies like ByteDance, and their users are now vying for attention between all these different apps, and the short video apps that ByteDance has rolled out are incredibly popular in China. And so users' attentions in China are being split between all of these new tech giants, and Tencent has to keep on outspending them to convince them to return with fresh new content.
All right, Bloomberg's Selena Wang for us. Thank you so much for that reporting. Coming up, it is the first big tech IPO in the United States for 2019. How are Lyft's investors reacting to the roadshow, and what do early investors have to say? We'll talk to two of them next. And later in the show, an experimental drug to cure Alzheimer's is a failure. We're going to discuss where the fight against dementia stands in the biotech space as Biogen loses 30% of its value. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Ahead of its IPO, one of the most persistent questions for Lyft is how it can reverse its losses. On Thursday, Lyft told a roomful of potential shareholders to expect expenses to decline next year. Ride-hailing has yet to prove itself as a sustainable business. These concerns could also impact Uber, which is expected to go public in the next couple of months. But Lyft is saying there is still more demand for shares than supply. Joining us to discuss, Floodgate partners Mike Maples and Ann Miura Ko. Floodgate is an investor in Lyft and is on the board. Good to have you both here together. And you invested very early, 2010, and this is right after you had joined the company. So they had kind of taken a chance on you, and you took a chance on Lyft.
Absolutely.
What did you see?
Yeah, so on the very first pitch that they came in with, it's a pitch that I still have, and I like showing it to Stanford students. But they talked a lot about why transportation was so critical to the fabric of the United States. And they started off with canals, and they went to railways, and then they showed highways, and how actually the physical landscape of the country changed and the economy changed as a result. And the question that John and Logan posed that I thought was really fascinating was, what's that next transportation revolution? And do you want to be a part of it? And my answer to that, and Mike's answer to that time was absolutely yes. There was nothing else in the market that was a transportation revolution.
Uber already existed at this point, though, right?
No, it did not exist at the time that we invested. So it was still.
And I think it was a black car service at the time, so it wasn't about ride sharing.
Yeah, so when Uber first launched, actually, it was Uber Taxi, and then they became Uber Black. And so even when they launched, there was still a pocket of time where the only comp that we actually could find in the market was Zipcar. And so that's what we were comparing it against. And sort of, is that the market? Is there something bigger than that?
So, Mike, what did you see?
Well, when you invest as crazy too early as we do, you have to have an opinion about where things are going. And so we'd been early in the sharing economy with Chegg and TaskRabbit, companies like that. And we had this idea that the internet lets you locate something that's unused, and the smartphone would let you locate something that's unused and moving. And so we were just looking for network transportation. And when Logan and John walk in the room and describe their vision for how things could be, we're like, okay, those are our guys.
Still, this is a company that's losing almost half as much money as it is making. I mean, they brought in $2 billion in revenue last year. They lost $900 million in revenue. How do you justify that to public market investors who are going to buy in now?
So I think this is really about the long game. And so we always return as early stage investors to the origin story and why 9 years ago we were complete buyers and why we are still buyers of what the vision is. And I think the really unique nature of this business is that this transportation revolution still hasn't played itself out. There's so much more to be done. There's so much more to go. So if you think about the potential of network transportation, as Mike talks about it, the ability for people to not just share the ride, but actually figure out all the different ways in which they can get from point A to point B, whether that includes an autonomous vehicle or not. There's so many new ways in which we're going to be adding and thinking about transportation that is going to actually start to change where people live and how they make choices about where they go. And so we've just scratched the surface of what's possible here, and that's my excitement about the future.
Now, look, it's not unusual for a tech company to go public and still not be making money, but Lyft is saying they may never make money. They say in their risk factors, we may never be profitable. You know, why should investors buy into that, given the extreme nature of this particular case?
Well, I don't really want to speak for Lyft or their numbers too much, especially in a quiet period. But
please do.
Yeah, the way I look at some markets, the product is so compelling and the value proposition is so compelling, it will be satisfied. And ride sharing was just one of these ideas where I don't know if you remember the first time you ever took a Lyft. But like, you just knew instantly it was going to be a huge success and that people throughout the world would be energized to want to get to places this way. And when the market will be satisfied, sometimes the best way to create value is to move very quickly. And so you know, our belief is that transportation is being reinvented and that it's a race to be the category king. And so in the early days, value gets created by gaining market share, by satisfying the demand. That's not always the right strategy, but I think in this case, the companies that have been aggressive and moved quickly have won over the ones that didn't.
So I agree, it is something that users want. It is something that I want. I've used Lyft several times. That said, what is the value of it? You know, what is to say? Who's to say this isn't the next Snap, where you go public at a big valuation and then a year later it's worth a third of what it was?
And again, so in the quiet period, there's very little that I can actually say about the company specifically and the financials specifically. But I kind of return to that notion of when you look at the original pitch deck that John and Logan pitched, you look at the founder's manifesto, and then actually the founder's letter. There's this incredible consistency to why they've built this business. And oftentimes, you know, Mike and I are looking at a company, and we're investing in businesses that we believe will be here not just 10 years from now, but 25, 50 years. And we call these thunder lizards, we call them legendary businesses, whatever you want to call them, right? We want to see companies that have this incredible length in terms of the story that they have. And one of the things that we've seen consistently is that these companies that have that characteristic have this storyline to them that's consistent from not only day one, but it goes throughout the length of the story of the business. And when you compare these three documents that I've seen, there's this incredible story of why this company needs to exist and why we believe that investing into these founders, you know, 9 years ago was a good idea. that story is so consistent. And that creates an authenticity that we absolutely love in founders that we invest.
So what that analyst said earlier, there's not enough information, I can't build a model, that doesn't concern you?
Again, these are not things that I can comment on.
Well, here's something maybe you can comment on, and we can transition to Floodgates business. You invest super early, and I think we give so much attention to SoftBank, which is making these massive investments, but you invest so early that your returns are massive. Can you share or do some of the math for us in terms of how big are your returns in this case, and how does that sort of shed light on your model in general?
Well, are you comfortable saying what the valuation was you invested in?
Yeah, we invested in a $5 million valuation.
Wow. So many, many times.
Yeah, it'll be, I hope it works out.
It's a good one for us.
Yeah.
So then, Mike, walk us through how this strategy has paid off for you. I mean, you were one of the first guests on this show, like almost 10 years ago now, and this was kind of a new thing, what you were doing, micro investing.
Yeah, well, I think there were a couple things. One was the dollar amounts that we wanted to invest in these companies. We saw lean startups becoming a thing. But the other thing that we were really excited about was democratizing innovation, and this anybody could be an entrepreneur. And so I decided it was an incomplete firm if we weren't gender diverse. And so I tried to talk Ann into joining. It took a while.
You figured this out long before anybody else did.
But here's what's interesting, and in a good bit of karma, one of the early companies that Ann backed, I think it was TaskRabbit, may have been your first even, and in a feat of karma, I suppose, Leah Buskey is who introduced us to Logan and John. And so I guess karma kind of worked its way around for both of us.
So where do you see the biggest opportunities right now? What trends are you excited about?
So the main thing I'm interested in is what I call putting an Iron Man suit on the solopreneur. And so a lot of the first generation on-demand services.
You can add an Iron Man suit to
so there's
Thunder Lizard collection.
Yeah, so a lot of too many metaphors, but a lot of the early on-demand services, Instacart, DoorDash, things like that, try to commoditize the person doing the delivery or try to commoditize the person doing the service. And we think that there's going to be a new type of service provider that we like to call on supply, where rather than robots eating the jobs, AI and software are going to allow individuals to force multiply and find customers and serve customers and have a billing system and a back office. And so there's 5 million gig workers, but there's 50 million solopreneurs in the United States. And I think that the next set of things we really want to look for are going to be things that empower those people, and that there's a little bit of a conceit, I think, in Silicon Valley that doesn't recognize that there's a whole lot of people who have self-starter instincts and can make things happen and aren't just passive consumers.
What do you think about the techlash that's happening now, the backlash against Google and Facebook and Amazon and big tech? Do you think that's a lasting phenomenon?
We've seen this story roll out before, right? So every time there is a massive technical shift, a gigantic set of monopolies is created. So if you think about processing power, IBM and DEC were huge companies in that time period, but ultimately microprocessors come along and disaggregate the power that they have, and Microsoft and software becomes this huge thing. But then the web comes along and Microsoft's powers ultimately decrease, and then out of that a new set of monopolies, FANG, emerges. And what you notice is in that storyline, every time that monopoly power looks totally invincible, that's when the next set of incredible monopolies is created.
So you were an early investor in Twitter. We've talked a lot about Facebook, the controversies, yet another one, the passwords of hundreds of millions of users were visible inside of Facebook. Do you think there's something that can, a social network, a new social network, that can disrupt Facebook at this point, or is the scale, is it too big of a monopoly?
Yeah, I look at it a little bit differently. So nobody really replaced the mainframe or replaced Windows. I think what happens is there's usually a new thing that emerges where a lot of the energy and investment goes to. And so that's what we're really interested in, is what will be the next set of companies that perhaps leverage decentralized data or democratizing the things that those companies are now aggregating and creating monopolies around. And so that, and I know that it's about to happen, because every time the government starts to potentially go after monopolies, quote unquote, the next great thing is about to happen. When IBM was in the middle of a lawsuit with the government, that's when Microsoft happened. When Microsoft was in the middle of a lawsuit with the government, that's when Google happened. And so, you know, it's ironic how the government action never really remedies the current monopoly, but then again, it never ends up mattering because the technology industry is just so regenerative that new architectures emerge and makes it irrelevant.
So do you agree that the power, even if you call it a monopoly or not, of Facebook and Google and Apple and Amazon will decrease and something will replace them?
They have to, yeah. So right now their power comes from the ability to aggregate so much data. So I call them data monopolies. What will disaggregate that is the technology that enables you to completely federate your information to the edges of the network and then actually apply intelligence to them. And so like the kinds of things that I'm looking at today, I call federated intelligence. That's where all of the incredible things that happen around mutating models happen at the edges.
All right, federated intelligence. I'm going to add that to, with iron, what did you say?
Putting an Iron Man suit on people. Yeah.
Iron Man suit. Okay, Ann Muraco, Mike Maples, always good to have you here on the show. Thank you so much for joining us. Coming up, the price of failure. Research on an experimental Alzheimer drug is halted and the company is in free fall. We'll look at the future of Biogen next. This is Bloomberg. $18 billion. That is how much of Biogen's market value was wiped out after the biotech firm admitted its experimental Alzheimer drug was unlikely to be effective. Biogen and its partner ISA are also halting research on this particular drug. However, they'll be working on other treatments for the disease that affects 5.5 million Americans and is the 6th leading cause of death in the United States. To discuss, I want to bring in our senior health reporter, Robert Landgraf. So, what was so promising here, Robert, that didn't work out?
Well, so drug industries for many, many years have been pursuing one kind of leading theory of Alzheimer's disease, targeting these plaques in the brain called amyloid plaques that are found when you do an autopsy of a person with Alzheimer's. And they've been pursuing this theory for many years. It's been touted by some of the most prominent scientists. The problem is there's never been any proof that the plaques actually cause a disease as opposed to being a mere consequence of the disease. And what's happened over the last number of years is that there's been failure after failure after failure among amyloid-targeted drugs among many of the big drug companies. And Biogen has had some of the most invested in this area, and they thought that their drug was a little bit better. People were hoping that it was more potent. They had an early stage 2 trial where there were some signs that it did, some hints that it had some effect on cognitive processes, you know, but when they went ahead into a very large, very expensive trial, and it just showed nothing in 2 of these big trials. There was no hint of efficacy at all.
Right, and this is a year before the results of this late-stage trial were even due. I mean, is there any hope out there elsewhere or at any other company?
Yeah, so this, you know, we've been doing some reporting today on this. You know, this does have some of the critics questioning, you know, why, because there has been a vocal minority of scientists that say, why is the drug industry so heavily focused on this one theory of Alzheimer's disease when quite a number of drugs have failed now, and saying we've been too, you know, narrowly invested in this one area and we should expand our horizons and focus on some other things. And there are some other theories, some other approaches that are in earlier stages are starting to emerge. There are companies, including AbbVie and others, that are working on something called tau, which is another aberrant protein that's found in patients with Alzheimer's disease. But I think, you know, what people have been telling me today that I've talked to is that the drug companies have gotten so invested in this theory, it's going to, you know, and the potential, you know, size of the market, you know, billions upon billions of dollars with nothing out there and nothing for patients. It's been very hard to stop. These programs got a momentum of their own.
So what else does Biogen have going for it? I know they're also, you know, working on multiple sclerosis. Yeah,
so they have, you know, so Alzheimer's is absolutely and surely was, you know, that was one of the biggest late-stage things in their pipeline, and they do still have another drug with ASI that they're still working on, still in advanced trials. It's also an amyloid-targeted drug, and its mid-stage trials also produce promising but very murky results. So, you know, I don't think people are going to be, you know, waiting with bated breath for that one. But that is still going ahead. You know, they're not the same, so you never know. Something could work out of that. Now, after that, they have a good selling drug for spinal muscular atrophy, but the problem with called Spinraza, and that's been one of the biggest successes in recent years. But the problem with that one is they're about to face competition. Novartis is coming out with a gene therapy drug very soon for spinal muscular atrophy, and then also Roche Holding is also working on a competitive drug that could come out in a while. So they're going to face competition for that. So they're not going to have that alone anymore. And then they're very strong in multiple sclerosis, but that's kind of a mature market. So people are saying, you know, what are they going to do now? You know, are they going to have to look to M&A, because this kind of, you know, this was one of the big things in their future, and not only did it not work, it had so little efficacy, and they stopped it a full year early, saying this is totally futile. We're not going to even keep going.
All right, interesting and certainly disappointing. Bloomberg's Robert Landgraf, thank you so much for your reporting on this today. Coming up, Apple has been on a hardware spree this week, and analysts are taking notice. What analysts are expecting to go into the iPhone maker's upcoming streaming event next. This is Bloomberg. Apple has announced 4 new products so far this week, including new iPads, iMacs, and AirPods. And analysts are turning bullish. The stock has gained in 9 of the past 10 trading days, suggesting rising optimism in advance of Monday's event, where the iPhone maker is expected to introduce a new streaming service. Joining us to discuss, Bloomberg's Alistair Barr. So what is making analysts so optimistic?
I think it's that this new reinvention that Apple is trying might show signs that it's working. It used to be a hardware company. For more than 4 decades, it's mostly been a hardware company. This is almost uncharted territory, but analysts, as usual, are getting bullish ahead of it and sort of modeling in a lot of future revenue from these new streams.
The information is reporting that Apple could offer bundles of on-demand streaming services for one discounted price. What's the significance of that?
So if you think about Amazon Prime, that's the one that everyone talks about. So you start with free shipping, which everyone loved, and then you layer in video, then you layer in music, you layer in everything else, and suddenly it becomes something that you can't live without. Apple could put together the video streaming, Apple Music, iCloud storage, all the other things it's got into one bundle and charge you, I don't know what it might be. Maybe you could spend $100 a month on it. That's a lot of revenue for Apple. That might be a really attractive service for Apple users.
Interesting. Now, the New York Times is reporting that the Apple News service are also expected to unveil a news subscription service. Will include the Wall Street Journal. So interesting, this coming from the New York Times, which is also, the CEO has also recently said they're holding back some articles from Apple News.
Yeah, so this is one of the challenges of doing an online services business versus hardware. Tim Cook's an expert at dealing with component manufacturers in Asia who are really, really keen on getting into the iPhone. Now he's going to have to go to newspaper publishers, movie stars, directors, and things like that. They're more wary rather of dealing with big tech giants. They're not so keen as component manufacturers.
So what are you going to be watching for on Monday?
I think the bundle is going to be a really big deal for sure. And then one extra thing, which I think would show how really serious Apple is it going to just provide these services to Apple device users, or will it be available on Android devices, on the web too? If that happens, that's a really big deal.
Big shift.
That would be a really big deal.
All right, Bloomberg's Alistair Barr, thank you so much. We'll be watching for that. And that does it for this edition of Bloomberg Technology. We are, as always, live streaming on Twitter. You can check us out there at Technology, and follow our global breaking news network, TikTok, on Twitter. This is Bloomberg.